Okay, so I was talking about global trends and saying the only real global trend was demographics, and this is the world population divided into the boomers and the millennials. Now I can see you're all sort of sitting there thinking, I wonder which one I am. Well, here's how you tell. Which of these do you recognize? These are the boomers and One Direction and the millennials. What's the important thing about them? Well, these guys are now pensioners. And of course, the millennials are the workforce, and I'll be talking quite a bit more about that. And importantly, they've changed finance because they've had 6 decades of saving, which I think has had a big impact on the built environment and real estate. But of course, we've got a different and indebted generation now, and I'm going to be talking about how that pans out and makes changes to both the investment world and demand for workspace, for living space and cities. So I think it's worth noting that by 2025, millennials will form over half the world population and 75% of its workforce. So these guys really are the future. But it is worth noting that although at a global level, the millennials are very important, there are a lot of countries, particularly European ones, that have actually been seeing their workforce shrinking. So what this chart shows is for selected countries, the decrease in the workforce, size of the workforce. So France has seen its workforce shrink by nearly 5% since 1986. Japan, of course, is the one in real trouble, over 12% fall in the size of its workforce from 1992. The English-speaking countries, UK, US, Australia and Canada, not shrinking quite so much and seeing the decline later, but nevertheless facing that sort of decline. So as far as skilled workers in Western economies are concerned, the search is on, and it's a global search for human capital, for talent, because we're not growing enough in Western Europe to go round. Therefore, we have to pay a lot more attention to Generation Y or the millennials and what they want. And we're noticing, for example, at Savills and indeed elsewhere, that it's the HR department that are very often coming to us with real estate requirements now for occupiers. Often asking the question not just what offices are available, but which city should I be in? And that's an increasingly important phenomena. It's not the cost of offices that are going to dictate the future of workspace. It's much more this search for global talent. I just want to illustrate that Generation Y is a global phenomenon. These examples were taken from all over the planet. I should point out there are females available, but they just don't have the same comedy value. What's important about them? Well, the important thing is that in their handmade satchels or their back pockets, they have a handheld device which gives them access to everything everywhere. And so, if these digital natives, this tech-savvy sort of generation, can do anything anywhere, you really need to attract them to your city and to have them be in your company or your city. And we've therefore become very interested in where these guys are hanging out and what they're doing when they're there. And the thing we keep finding is that this is their natural habitat. These are all the sort of hipster hangouts around the world, where there are also concentrations of creative industry, which is any industry that sort of creates intellectual property, and tech industry. So what you might call creative tech rather than hardware-reliant tech. What's important about all these places? Well, actually, they have a very old-fashioned sort of street scene. They are not big boxes in the middle of Silicon Valley. Google every day have to bus thousands of people from San Francisco, where a lot of them want to live, work, play and visit, out to their campus in the valley. And I think we're seeing that the coffee shop, the availability of a flat white coffee is actually as good an indicator of the quality of a city as anything else, because it indicates that there are informal, flexible spaces at ground floor level where people can do all sorts of things, but most importantly, where they can meet and interact with other people. Because in a world where you can access everything everywhere, the only thing you can't access is a face-to-face meeting with a human being. And that's what these sorts of environments facilitate. So tech cities are remarkably low tech. They're places where people can be. And we're seeing this very urban preference for workplaces show up all over the place. This happens to be a survey done in the UK, but we're seeing the same results certainly all over Europe and the US. Overwhelmingly, especially young generations want to be in a town or city centre. What they don't want to be in is an out-of-town business park. So that is really, really changing demand for cities. And it's actually led us to think about the evolution of cities over centuries and to suggest that we're entering what we're calling the fifth age of cities, the digital age. And to try and take you through this very quickly, what we're thinking is that in the pre-industrial age, what mattered about a city was your ability to meet other people, be proximate to other people for the guilds or the workplaces for trading and so forth. In the early industrial city, it was all about proximity to raw materials. And that was the first phase of urbanization. Then we moved on to a kind of mercantile phase where trade and proximity to markets mattered. I would suggest that certainly in the late 20th century, we've gone through a phase of the capital city, the age of capital, where what matters about a city is its concentration of capital and your ability to access financial capital into it, in it. And now this digital age actually starts to look more like the first stage, because what matters again is proximity to other people. So it's the access to human capital, not financial capital, that is starting to matter more. And one of the things we're finding as affordability issues press on some of the most popular cities, that actually we're starting to see what we're calling urban dispersal, where small towns and small cities associated with the big city are starting to gain in popularity and start to be occupied by those digital natives. So that's a quick canter through our ideas on that demand side, as it were. But there are also implications of demographic change for investment. I'll try and canter through some of these ideas quickly as well. The first is that over those 6 decades of the late 20th century and early noughties, when the boomer generation was saving money, the aim of the game for an institutional investor was to deploy large amounts of capital, which was being received on a regular basis, in as large a lump as possible. So in terms of the built environment, I would say it's resulted in concentrations of capital in buildings. Big buildings, single use, so they can be managed within a large portfolio. And I think that's now changed, because suddenly those same institutions have to pay the pensions. So the emphasis in the investing world has shifted from deploying capital for capital growth to creating long-term stable income streams, perhaps from some quite diverse holdings, and managing that income for over a long period. Now that's a different game. And I think we're just at the foothills in the real estate world of understanding how that's going to impact. I'm sure a lot of you are aware that so-called alternative assets have become very popular lately. Now, some of my colleagues say that's inevitable. It's a late cycle play. You know, it shows we're at the top of the cycle when people start buying student housing or hotels or even residential property. But actually, I say that it has at least something to do with this change in the need for income, because these higher yielding asset classes can produce the sort of incomes that the institutions need. So I would suggest that demographic change is actually at the root of a change in that investing environment. It's also, of course, changed the demand for fixed income assets of all types, including government bonds. And I think that also has changed the overall yield environment. And I just want to illustrate this by showing you, this is the average bond yield for US, UK, Germany, Japan, Canada, and Australia before the financial crisis, 2000 to 2007. This is the same average bond yield for those same countries after the GFC. So you can see there's been a big yield shift, not just in real estate, but in all assets. And I want to translate that yield shift, that's 170 basis points down, into a capital value increase. Because as yields have gone down, asset values have risen. Now that shift is enough to account for 64% capital growth by itself. So a lot of the cities that we look at have experienced very strong asset price inflation over the last few years. That is down to that changed yield environment, which in turn is down to some extent at least, not just to the actions of central banks, which undoubtedly has been a big issue, but also the demand for fixed income assets globally. And that has impacted, I've taken for an example here, this is residential property in London. You can see on the right-hand side, huge growth in the prime markets, that's the top end of the market. They took off really fast. They've grown by about 80%. So I think a lot of that 64% yield shift growth has actually come through in that market. What's really interesting to my mind is that about the end of 2014, it stopped. It was complete. A yield shift from high yields to low yields can only happen once, and because you can't go below zero base rates. And now what we're seeing is that capital growth is very heavily reliant on rental growth. So I think this is an object lesson in what is happening, either has completed in a lot of the global gateway cities like London, or is still in process of happening in many cities in Europe. You're going to see this one-off capital growth, asset price inflation as a result of yield shift, followed by a return, if you like, to the fundamentals of rental income and rental growth. And so increasingly, my prognosis is that we're all going to be concentrating a lot more on occupiers, what they want, what they need, how much they're going to pay, and how the income's going to behave over the long term than probably we have been in the past. If you want to know where bond yields are headed now, over the past year, expectations of US Treasuries has moved out by 26 basis points. That equates to a capital value fall of 11% or rental rise of 12%. So you can see that probably as interest rates do start to move out, we're going to see a separation between the cities that offer growth, rental growth, and those that don't and can't, as it were, keep up. Where are those going to be? Well, this is a graph of all our global yields. We make them comparable by measuring net effective yield. So that's income after any concessions and incentives and rent-free periods and so forth. And in Europe, you can see there's a very wide, there are the red cities. We've got Warsaw and Dublin up at the end high yielding, probably with some scope for further capital growth. But the global gateway cities, particularly London and Paris, are probably pretty fully valued in asset terms. And there are signs that the yield shift is complete. Asia and Europe, on average, have come in and are still coming in, but the more sort of, there are a group of advanced markets, if you like, in US, UK, Australia and Canada and so forth, that are actually starting to move out again now. So that's, if you like, a big global picture, canter through what changing demographics and changing populations might be doing. Let's have a look at what's actually happening in Europe. There has been urbanization in Europe. It's not as fast as emerging countries in other parts of the world, like Asia. And that's largely because Europe is, of course, highly urbanized already. But some cities have been popular, others arguably less so. I think Paris definitely stands out in contrast to London in this respect. Most European cities, though, are growing at modest rates, or have been growing at modest rates of increase over the last 5 years or so. That ability to attract incomers and attract new populations does seem to be reasonably closely linked to economic growth. Again, contrast here, the faster growth in London compared to Paris. Also, though, some of the Eastern European cities obviously growing off a lower base, and Dublin sticking out as a bit, the return of the Celtic tiger, as it were. There's undoubtedly things that cities can do and countries can do to enable this growth, and it involves both the movement of talent into the city or country and the ease of doing business. I think some of the fastest growing cities are also those that score high on the ease of doing business sort of ranking. So that's something that needs to be paid attention to. And undoubtedly, taxes seem to have quite a big impact. All of these charts and so forth are in a document that we produced recently called European Cities. It's available online if you want to take a closer look. But it is noticeable that here Paris has the highest corporate tax rates and personal tax rates, in contrast with, for example, the fastest growing city, which is Dublin, which has the lowest, notwithstanding the EU's finding of Google recently. Tech employment is an important part of that immigration and growth story. This is, for want of a better word, tech employment in 2016. And you can see how it's concentrated in some of the cities that we've adopted as European tech cities. We're saying Stockholm, Copenhagen, Berlin, Amsterdam, London and Dublin probably stand out as key tech cities in Europe. But I think the interesting thing is how that pattern is due to change over the next 10 years. Oxford Economics forecasts that by 2026 there will be distinct little red glows further east, and I think this is of particular interest to this conference. Probably what's gone under the radar is the fact that already tech, communications, technology, and so forth employs in many European cities more people than the finance sector, and that includes London. London's known as being the finance sector of Europe. It actually employs more people in the information communications technology sector than in the finance sector. Madrid, the same, Paris even. So there are plenty of European cities which are already seeing a shift from that old concentration of capital to the concentration of human capital and the concentration of tech industry. A big indicator of how well a city is going to do in that new technology sector and the more creative sector has a lot to do with a combination of what we call city buzz, how much is going on in the city culturally and socially, and combined with well-being and wellness. And that combination seems to give a pretty good indication of which cities are going to be performing and attracting those millennial workers and talented workers into the city. There is, of course, the pure tech environment issue. This is the availability, for example, of 4G. Really interesting to see that, for example, Lithuania is right up there in the provision, and in some cases we do see new technologies being more capable of being adopted early in less entrenched and regulated parts of the world, shall we say. So what are the prospects out of all this for Europe and European cities? I think we're going to become, as I said earlier, increasingly focused on the rent cycle, where cities are in terms of their rental growth prospects. Whether the rent cycle will be quite this pronounced, or whether some cities will be able to, as it were, leapfrog the down phase, or at least make it a bit flatter in future, I think is open to question. But clearly there are certain factors, certain key indicators about the city. And if you like, the city has become a commercial entity, has become a factor in how well that real estate is going to perform. So the prospects of rental growth are increasingly attached to the fundamentals of the city. And Europe does still look good value for occupiers. I think on a global stage, there are good cities with a lot of that city buzz, city wellness, which look cheap compared to the global cities. The thing to watch out for, and I think what's going to increasingly come into focus, is residential property affordability. We see that as a major driver influencing people's decisions. And again, some of the European cities actually look well placed in that respect. This is rental cost per worker, wide range of workers ranging from CEOs right down here. And underlying all that, there is the demographic strength of the city. So I'll be asking questions on this later, so you've got to study it carefully. No, seriously. Basically, what this shows is our ranking of the demographic strength. So, for example, how the workforce is forecast to grow, the ability of cities to attract that workforce in future, the millennial to boomer ratio, how many aging people the millennials actually have to support in a city, strong indicator of the kind of pressures that might be on social and health services, for example. The elderly, outright elderly dependency ratio as well. So a whole host of demographic indicators actually separating the cities which we think are going to do better and those that might struggle more and need to actually boost their appeal to younger generations. So there you have a canter through our sort of latest thinking from the global to the more sort of specific European level. I'm very happy to sort of discuss it more in the following panel session. Thank you.